Hello and welcome to Options Guide TV. My name is Brian Overby. I'm the author of the Options Playbook, and I'll be your host for about the next 20 minutes. We're going to be short and sweet here on Options Guide TV. We don't really have a trade that we're looking at. We have an IWM long straddle that we're probably going to have to get out next week. We're not getting the movement in IWM as much as we would like. We did one bearish trade in IWM, and that just broke even, just a simple, straightforward trade. And that's the only position that we have on, and it's not worth looking at this point in time. So I'm going to do a short-term trade today. We're going to look at the S&P 500 index. And I should let you know that today's date is Friday, June 21st, 2025. And we're going to literally just do a butterfly and watch it play out over the day. So I do think that one of the things, well, it's always interesting to watch how butterflies move. There's such a pricing mechanism that is used across the markets, actually, prior to pricing models and continued updates in a lot of these option contracts. So we're talking all the way back when the exchange was first opened up. A lot of market makers would use butterflies because you always wanted to make sure that your options were priced right so that somebody couldn't buy an at the money butterfly and actually buy it for nothing, meaning that they pay either receive a small credit or get it done for even, and then they have no risk on the table. And if the market goes out anywhere near where the market is at, you could actually have a home run in a butterfly. So you always had to make sure that your butterflies were not pricing in an advantage to somebody that came in and actually wanted to execute one. It was just a way. Butterflies have always been a real interesting pricing mechanism for index traders, for anybody that was making markets in any underlying stock. Nowadays, it's all taken care of with models and skewing, and there's not going to be a case where you're going to send a butterfly to the floor all as one trade, and it's just a standard butterfly and get it done for a small net credit or even to the account. There's really nobody that or the markets are efficient enough that does not happen anymore. So we're going to go on the good old SPX. We're going to go at the money, kind of think the market's just going to settle down. It's done this today. We got the VIX still up. So since I started looking at the markets this morning, markets were a little scary to start off. Bearish signs all over the place. VIX jumping up above 13. And just showing some weakness in the market, but the market just came all the way back, and now we're almost flat. So in the S&P 500 index, we're actually down 1 point in that index. So you could say that that's a bullish move to the upside, or I think we're just going to kind of hang in this range. And I do actually have that forecast for the S&P 500 index, and that I think that today we're just going to let the markets play out. And one of the benefits, there's two trades that we could look at. We could look at an iron condor, which is a safer trade, but has a little bit more risk in that you would go out further in time. And the max risk, you're going to be bringing in a small net credit to the account relative, and the max risk would be higher than what we're going to look at in this butterfly. But today we're actually we're in the range of the time decay on one-day butterflies on expensive underlying indexes. You don't get them done for cheap. If you go out in the SPX and you do a 10 or 15 point wide butterfly and you give it 2 or 3 days, that would be a cheap butterfly. It would be trading for less than $1. Today, we're going to pay some real money for the butterfly, but we're really at that stage when you look at from noon until expiration in the SPX, the at the money option contracts, and we don't need to go there just yet, but I'll just tell you, for example, markets at 54.71. So the 54.70 SPX at the money option contract is still trading for $9.30. It's a very expensive option contract with half a day remaining. And like I said, the VIX is up a little bit. So that's a good thing for the butterfly when you're initially putting it on. So we're going to sell that option contract because by the end of the day, if the market stays where it's at, that has to go to zero, right? All the time premium in that option contract has to go to zero. We're actually about 1 point in the money in this instance. So we're going to then buy the wings. So we're going to sell the at the money option contract and then buy the wings. And we're going to go out about 15 points. And it's going to be a fairly high break even because we're going to have to pay a decent amount of a debit. But the landing zone or the wings of the butterfly will be 15 points on each side. So 30 points total minus whatever the debit is that we paid for it. And we're going to put the trade on and I'll send out a tweet by the end of the day. My handle's at Brian Overby, just to say, well, this is when I would have got out of the trade. There is an adjustment that you might do on the trade. You can always roll if the market starts going up, you can roll it into a short call spread if you would like. But I don't think we're going to do that today. I think we're just going to trade it. If the market goes too far against us, if it doesn't stay within this 30-point range, or which will end up being, all said and done, probably you want it to stay within a 20-point range of where the current market is at. And if that does not happen, we'll probably just close the trade and just move on. But I'm looking for less volatility going into the end of the day. Things just kind of settle down a little bit and maybe even see the VIX come off a little. If that does happen, VIX dropping down helps the butterfly after you initiate the trade. You want volatility in theory, you want volatility high when you put the trade on. And if you're correct on your forecast, you want implied volatility to go down. So let's do it. And like I said, it'll be a short and sweet Options Guide TV. But by the end of the day, I will send out a tweet saying we're in, we're out, or where we're at with this trade. So let's go to the Tradier Pro software. And if you haven't done it yet, you do want to go in and upgrade to the Tradier Pro, new software from the TradeHawk software, which that's what a lot of the Tradier clients would know. Made some improvements, did a little bit of a lot of stuff with actually the interface and added a few new features. So with that said, we're now in the Tradier Pro software. We have the SPX up. I showed the VIX is trading up about 1324. SPX now is down 2. It was down 1, I guess, when we first started looking at this. The market is at 54.71. The options grid highlights the most at the money option contract, which is very nice. We talked about a 15-point wide trade on this, and it'll be fairly expensive because we only have a half a day for these option contracts to live. And as a matter of fact, I should point out, and this is highlighted inside the Tradier Pro software, is that there are 2 June 21st expirations. And it's very important. Well, this expiration, the options have already stopped trading because they did the settlement this morning. On the normal old school SPX option contracts, those stopped trading on Thursday, and on Friday, they just come up with a settlement value. So on the SPX W, these are weeklies, and they stop trading at the end of the day. And you can see here that there is a difference in the symbol, but you got to notice it. So you want to make sure that you're trading in this expiration. There we go. Now we're getting closer. I like it to be right at the money if we can. 54.70, and that's about as best as we can get. So now we're going to go down 15 points. So we're going to go down to the 54.55. That's going to be our first leg of our trade. We're going to sell these two at the money. We're trying to get as much juice to come out of those option contracts as possible. And then we'll go up 15 points. So we're talking about 54.85, and we're going to buy that. And our net debit is, we'll call it $4.50. $4. Let's go for 40. It really jumped, didn't it? All right. Now it's 417. 420. All right. So if you want to know where your break evens are at, you take that net debit. We're going to call it 420 of 54, the strike, the high strike. And I'm going to point to this in our spread. So let me scroll down and get this thing all pretty for you. 54.85, and you subtract $4.20, and you come up with 5480.80. 5480.80. $5,480.80 is where our break even is at. 5485 minus 420. 5480.80. Okay, so that is the high. We don't want the market to go beyond that because we got a very short expiration, and I'm going to write down that break even, and I'm going to show it inside the what if calculator too. So that will highlight the break evens also inside the what if calculator. Then on the downside, it's very simple. You go 54.55 plus 420, and you get 54.59.20, and that's where our break even is on that side. Okay, 54.59.20. 420 is what we paid for this trade. $420 to put the trade on for every 1x2x1 butterfly. That means our risk is $420 if we do just one butterfly. Our upside is it could trade for as the width of the spread. So it would be $15 minus that 420, or $10.80. Now, that would only be if we went out right at the strike price, or at the short strike price of 54.70. So if we put this trade on and we can make a couple of dollars, we're going to get out. Time decay is going to be huge from this point forward on these option contracts. And if we stay right around 54.70 for the next couple of hours, that could mean a dollar, dollar and a half before we get closer to that expiration date. Don't want to try to hang around and try to hit the home run by the end of the day, especially if I'm just doing one butterfly. Maybe if I had two, I might sell one and then try to play with the second one. But in general, not looking to try to make the maximum $10.80 on this. We're just trying to make a few dollars on the trade from time decay and then get out of the trade. So I'm going to send this to the what if calculator. And we'll zoom in here a little bit. Let's get rid of this. All right. And we'll zoom this way. So here is where we are at. If we do this trade right now, we're standing right at this precipice, 54.71. It's dancing around that strike. The line is right here as of today, and that will start gradually climbing the mountain if the market stays within that range. Now, also note here that if you go all the way to the expiration, the maximum you can lose is that $4.20. It's saying 440, but we're implying that we got it done for $4.20. We saw the market there. And to start with, you don't have a lot of profitability, right? Because you need the time decay of those at the money option contracts. But also, if it were to spurt up, if we put this trade on and it instantly jumped to 5,500, right? You would be down about half your value according to the what if calculator. And you can see that you got your cursor, you want to look over in this range, but 550 right there says we would be down $262 on the trade. So to start with, if you're correct on your forecast, you want time value to erode, you want implied volatility to come down, and eventually close somewhere close to your middle strike, your short strike on your butterfly. If the market jumps one way or another, it's better that it does it right away, because if you can get out and you still have some time value in your long option contracts, which are protecting you, that time value actually in the long option contract saves you a little bit. And that's very apparent. This is a much more parabolic shape than these hard lines and basically mountainous profit and loss graph that looks that the way a butterfly looks at expiration. So just a fun task. See how a butterfly decays as expiration approaches. I do not mind this trade though as a one-off trade. Looking what has happened in the market and what we have left in the rest of the day, interesting way to trade. And every once in a while, I don't mind putting on a half a day butterfly in the SPX, in the NDX, something that has that's a fairly high value underlying index. If you think volatility can tame down a little bit going into the end of the market. All right. So if we have any questions or comments, once again, if you're in the Tradier YouTube platform, you can ask questions in the chat box. If you sign in to the Tradier Hub, where you get to see all the speakers that are a part of the Tradier Hub, inside there you can also ask a question, but you must sign in. And then obviously we also stream this live on Twitter. If you're on x.com, hello and thanks for joining in. And you can obviously tweet me directly if you would like. Send me a message if you have a question about the trade or the show. And that's going to be it. No questions. That's going to be it for this edition of Options Guy TV. A short and sweet, as promised. We'll be watching this trade. I have it on inside my own portfolio, and I will be watching this trade today, and I'll let you know what happens with it. Thanks for stopping in, everyone.
Thanks for watching. Please be sure to take some time to read the disclaimer. Thank you.